Hello traders, Cousin Vinny coming to you from theclosingprint.com, May 1st, 2022. In this edition of your weekend video newsletter, we'll discuss stocks which fell sharply on Friday to end one of the weakest months in recent memory, with the Nasdaq losing 13.2% to register its worst month since 2008. At the same time, the S&P 500 and the Dow lost minus 8% and 4.9% respectively, experiencing the worst month in 2 years. With very few bullish setups and our indicators giving us 16 bearish, 1 neutral, and 3 bullish, we're looking at S&P 500 support at 4,100 and resistance at 4,300 for this week. Bottom line, we're hedging and reducing risk to start the month of May. The Nasdaq market lost 13.2% to register the worst month since 2008. S&P 500 lost 8.8% with the weakest performance in 2 years. At the same time, small caps, the Russell 2000 pulled back almost 10% for the month of April. And considering the U.S. indices altogether, we have pretty bearish sentiment with the AAII bull-bear ratio at extremes that we haven't seen since the 2020 COVID drawdowns in the markets. This is something we're watching very closely, along with valuations, which have pulled in dramatically from the 2021 highs that we saw in stocks like GameStop, which in 2021 went ballistic. Those valuations are contracting to more reasonable levels that would expect to see institutions starting to pick up in quality names as they pull back, together with sentiment and a pullback in GDP falling 1.4% for the first quarter, with the assumption that the Fed will raise at least a half a point on Wednesday at the FOMC meeting, or even in some cases, some financial media speculating at 3/4 of a point rate hike this week. So we have to wait and see what institutions do after FOMC. In the interim, what we're doing is hedging and reducing risk. We are hedging with products like QID, SPXU, SQQQ, SDOW, among others. Since the March 29 peak, we've told you repeatedly over the weeks that followed that we were reducing our risk from 79% exposure to equities to currently 50% as of Friday's close. We'll continue to rebalance our hedges this week after reassessing the market and sentiment Monday, Tuesday, and Wednesday. By Thursday, we should have a pretty clear view of what's coming next, so we can plan accordingly. Here is the bond stock ratio. It doesn't give us much to go on, though it's signaling that we should favor bonds over equities as the ratio moves higher, the red line. In addition, indicators such as junk bonds and high-yield corporate debt are both weak and descending. These tend to lead the markets lower. As you can see, we peaked just before the January highs and started pulling back, moved below the 65-period moving average, continuing to accelerate to the downside until junk bonds and high-yield corporate debt start to bounce, along with sentiment indicators. This is more bearish for equities in the short and intermediate term. At the same time, the 10-year yield has accelerated very quickly at the fastest pace in more than a decade. That's putting pressure on tech stocks, while the US dollar makes new highs, showing a potential for a consolidation in the short term in this safety trade. And with that strength in the US dollar, putting pressure on economically sensitive commodities like copper, which is a indicator of economic strength, along with industrial production, which is continuing to move higher. So copper is currently telling us to be cautious, while precious metals like gold try to bounce this week. Also silver looking for a bounce, palladium. At the same time, we see US dollar priced Brent crude consolidating above 100 for the past 8 weeks as geopolitical events continue to bolster its price. Bottom line, commodities are telling us to be cautious as well. Defensive consumer staples were the only sector to gain ground during the month of April. Energy, utilities, materials, real estate, and healthcare also held up relatively well. The biggest sector losers were consumer discretionary, minus 16% for the month of April, technology, minus 13%, financials, minus 12%, and industrials, minus 9%. That combination shows investors are selling more economically sensitive stocks and favoring more defensive ones. Economic news also turned negative. Bottom line, you want to be cautious going into this week. So, we'll hedge and reduce risk. For the week, IBD 50 saw these 5 stocks move higher on the week, showing relative strength. Relative strength stocks at new highs. We're also watching for stocks like Merck and LNTH in the healthcare sector to continue higher. We're looking for stocks that are showing relative strength to continue this week. Asbury Automotive did fairly well last week. This is from the IBD 50. Looking for a follow through or a flag right here at the 200 period moving average. RSI is above 50. Stock is showing relative strength. With MACD above its signal line and stochastics rising, volume increased on Thursday and Friday. Carlisle was also in the IBD 50. This is a diversified industrial making new highs and showing relative strength with RSI above 50, volume increasing dramatically on Thursday and Friday in the face of weakness. MACD and stochastics both pushing higher as well. Novo Nordisk, also on the IBD 50. It's a Denmark-based developer of insulin analogs, human insulin, and oral anti-diabetic drugs for diabetic care. Showing a nice cup and handle pattern. Out with earnings, beating by 7 cents, a 30% surprise. Volume following its earnings release. NVO showing potential as a trade. We're watching momentum indicators which show that we could see a lift off of this 10 EMA on the weekly time frame. So watch NVO this week. Olin Corp, the company manufactures chloro, alkali, and small caliber ammunition. Showing up on the blue dot scan. Nice cup. Looks like a potential breakout on the daily time frame. OLN on the weekly, showing that base, looking for a follow through. Momentum indicators are starting to turn, looking for a continuation this week. Along with Lantheus, which was on previous watch lists, looking for a follow through. This developer of diagnostic medical imaging agents and products for the diagnosis of cardiovascular and other diseases shows a high relative strength line at 99 as the stock breaks out. Good earnings, beating by 92 cents from a year ago earlier, a 470% surprise, and something we should keep an eye on in this healthcare related name. With very few stocks on the list that we're following, it's telling you to be very cautious. If you're in positions and you haven't taken anything off, consider selling covered calls, hedging your positions. QID was up last week 6.48%. While we continue to hedge and reduce risk going into this first week of May. We'll send out a watch list later tonight. I don't expect that there's a lot that we'll be putting on there for this week. I'd like to see how the markets react by Wednesday, FOMC. So the bottom line is hedge, reduce risk. We'll take some day trades during Monday, Tuesday, Wednesday. However, swing trades are going to be a lot more risky, a condition where we need to exercise a little bit more patience going into the week. I'll send that out around 11:30, 12 o'clock on the East Coast, about 9 o'clock on the West Coast, so be sure to look in your inbox for that. Not expecting a whole lot. Have a great weekend, everyone. I'm going to take the wife out and the kids. It's our 16th anniversary. Take care. Have a great weekend, and we'll see you in the morning. Ciao.